Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. This webinar is the first in a series of 2 webinars titled Price Action and Chart Reading. The goal of this webinar is to help you to improve your skills in chart reading and applied technical analysis. Many traders apply way too simple or way too complicated approach to analysis, and in this series of webinars I will focus on things that really work, that were proven by real trading. I will try to support each idea with charts, and all ideas discussed in this webinar were somehow used for trading either for me or students of my educational groups. So, it is based on practical experience. I hope it will help you to improve your trading and improve your chart reading skills as well. And now we are getting started. Before we start, let's take a quick look at the disclaimer. Please be aware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using a historical backtest before putting real money at risk. And before we talk about chart reading, it's worth mentioning that there is a difference between small and high time frames. Often traders think that markets move similarly on every chart, on every time frame, but the smaller time frame you analyze, the more noise and conflicting information you are going to have and you're going to face with. And now, what do I call the noise? Just remember that intraday action is often affected by numerous algorithms, very short-term traders, high-frequency robots and other participants that create a lot of false breakouts, numerous tests. Price action on 5-minute or 15-minute chart is going to be more confusing than on daily or weekly chart. On the one hand, you will be able to find numerous setups on 5-minute chart. On the other hand, each time price moves on this time frame, it can be the result of manipulation, false break, or any other similar reason. If we say that we have ascending move on a daily chart, like you can see on this slide, we will rarely see market going straight to the target. It will rather go back and forth, return to a starting point, then we'll move again, and eventually we'll reach the destination. So if you trade within a day, you can easily fall a victim of manipulation. I don't say that it is impossible to trade within a day. The majority of my own setups occur within a day, and this is not impossible. And if you do everything right, you can improve your profit-loss ratio significantly and have greater leverage in your trades. Yet you have to learn how to filter irrelevant information which will dominate for small time frames. As for larger time frames, information is already filtered, because when daily bar or candlestick closes, it can show us real destination of a move. The majority of traders who trade within a day will never hold their positions overnight. Therefore, you see more clear picture analyzing large time frames. That's why candlestick analysis will be of more value in application to larger time frames. And as for smaller time frames, we have to learn to read hidden clues and nuances that represent big market participant beyond the action. When we start looking at the charts, we have to remember that technical analysis was brought to general public by Charles Doe, who was a financial journalist and a writer. Many traders remember that technical analysis claims that price includes everything or similar things, and yet Charles Doe had said not only this, but many other useful ideas as well. And I want to focus your attention on one of his ideas that can be very useful in trading, and we are going to go through this idea in this webinar. It claims Every market move or a trend has three phases. The first is accumulation. The second is phase of public participation or the impulse phase. And the third one is a distribution phase. Every market movement except maybe very short-term intraday movements can fall into this structure. And this is critically important to distinguish one phase from the other because successful trading idea will require detailed market understanding. Accumulation phase or accumulation era is considered to be an era where informed players or big market participants slowly accumulate new positions. It can be represented in the way they buy here, they buy here, they buy here, something like this. This phase is often represented in the form of a large trading range. But it's not an axiom because it also can be represented in the form of ascending or descending channel, but the large trading range is more popular or more understandable configuration. There are two major misunderstandings among traders concerning accumulation phase. The first is that traders often think that moving price itself is a sign of accumulation, or better to say, it is a sign of support or resistance. But think of a price as an advertising mechanism. Market advertises higher or lower to attract responsive action in order to bring situation into balance. Not always it is a sign of new money participating in the game. And the second misconception is that market is being supported necessarily by responsive actions from horizontal lines. I would say that more often than not it is a sign of smaller time frames involved in the game. Day traders or algorithms who are buying very mechanically from a given level are not represented strong side of the market by definition. So it's not a reliable support. So accumulation areas are often represented in the form of large trading ranges with either significantly volatility or reduced volatility. The less volatility is, the better. When we talk about accumulation, we can also use this term as a metaphor because not only supply or demand can be accumulated, but also market can accumulate expectations or it can accumulate information for generating next trading idea. As time goes by, market accumulates information and prepares to exit a trading range. But market rarely rapidly breaks a range with immediate acceleration in the direction of the break. Market is changing the dominating paradigm very slowly or pretty slowly. First it has to validate the area. It has to validate the area outside of a range to make sure that supply is really drying up and that nobody is going to push the market back into the range. After that, when there is really no more supply to hold the price, market is ready to break. Once it breaks out, everyone starts to see the trend. And we are talking about paradigm shift in this case. General public or the majority of traders now are able to see the trend. They try to step in and act upon this opportunity. Well, it's not really the opportunity, but general public perceives this as an opportunity. And one of the biggest mistakes traders ever make is searching for an active trend, to jump in this trend. Before the market is ready to go to any direction, it has to go sideways for a while. It can be easily explained by the market logic, but also it can be explained by pure statistical studies. Market is generating sideways action 70% of the time, and about 30% of the time it is consolidating. So, entering a position after market has already generated a move, you increase the odds of getting into the trading range or a whipsaw. Your stops can be whipsawed in this case. So, for example, if you are entering here, you got whipsawed by the price action that is followed. Before market ever reverses, it also first has to consolidate. Of course, there are minor exclusions from this rule, but in general, market has to consolidate first before any meaningful movement. So if you ever want to search for a good opportunity, I would recommend you to search for a trading range. The more time market is going to spend within a trading range, the faster it is going to switch to a trending phase. On this slide, you see the example of the setup I will pay attention to in the nearest future. It is Euro versus Japanese yen. This market is consolidating with price leaning to a lower border of the range. It does not necessarily mean that it will break to the downside, giving us opportunity for a good trade. But I will keep an eye on this market because price is about to break to any direction after such a long period of consolidation. Another example shows the dynamics of American dollar versus Canadian dollar in 2014 followed by 2015. You see that before market is ready to generate a trend, it consolidates higher and higher, testing and validating higher levels and areas, and only after that it is ready to break. More recent example can be viewed on the chart shown here on this slide. It is American dollar versus Japanese yen. Before exiting a long-lasting trading range, market is validating higher levels. It is testing or validating higher levels. It builds on one side of a range, building an additional structure or an additional trading range. I call it paradigm shift. I must warn you that we don't really know the exact destination of the future break before it happens. There are plenty of situations when market leans to the upper side of a range only to break out to the downside. In this case, we are talking about market becoming overbought or oversold when inventory becomes too long or too short. This scenario often occurs when there is no real accumulation in a trading range, but rather we have just a random walk with reduced volatility. And to generate a move, market first have to collect stops or generate a shakeout, and only after that it is ready to go in the opposite direction. The most recent example of a strong market preparing for the breakout was American dollar versus Canadian dollar. I was showing this example before in previous webinars, but I want you to show it once again. I was trading this in real time, so it's pretty interesting situation to analyze. Paradigm shift means that market isn't convinced in a strength yet. There are still sellers that want to push the market down because they see relatively high price and they are ready to react upon this price. They perceive this as an opportunity. Remember that Forex trading as well as futures trading allows any big market participant to bring whatever volume they want to the marketplace. They don't really need to borrow any assets to sell it like in the stock market. They just exchange obligations. Short position is an obligation to sell and a long position is an obligation to buy. On a spot market, players have 2 days before they have to deliver the whole position to the counterparty. So they can push it with significant volume and they have pretty short-term perspective before they will have to close those positions. Less than 2 days. And the area of paradigm shift allows trader to build position with low risk and high expectation of reward because the volatility in this area is often reduced. The lower volatility you have, the smaller stop you can set. For example, my trade location was here with a stop 25 pips below this entry point. Traders can have 2 good trade locations in whole in area of paradigm shift at the lower side of the distribution, as I have shown you before, and at the higher side of the distribution. The first type of trades can be called pullback trades. It can be called pullback trades. The second one, of course, are considered to be breakout momentum trades. You already know them from the previous webinars. Every pullback trade is by definition counter trend trade, so you have to be careful and not place very tight stop. In my trading I use average true range indicator for measuring volatility. For pullback trades I multiply value of an indicator by 2 or 1.5 and project this number to the downside as it is shown here. Entry point is here, double ATR gave me opportunity to set a stop close to 25 pips. For 30-minute chart, parameter of ATR indicator has to be no lower than 20 because you want to capture different candlesticks or different bars to calculate volatility close to a real volatility. Because if you take this parameter less than 20, you can take 10 candlesticks, 10 doji candlesticks, and your ATR will be very, very small. So you have to use many candlesticks with many parameters for your calculation. For breakout momentum trades, it is okay to set stop loss with 1 ATR from your entry point. But for this particular example, we really don't have the good momentum trade or good trade location for a momentum trade here. Here is another example of paradigm shift shown on this slide. Before breakout to the upside, market is consolidating and thus validating the break. I want to pay attention to one important nuance. When price emerges from a range, it can fail to test a level that was broken out before. It is often a sign of imbalance. Supply is so weak that nobody is really interested in pushing the market down. When you see such kind of situation, you can play a breakout momentum trade. Setting your buy stop order just above recent highs, like it is shown here. And of course, it is not a guarantee of successful trade. Market can generate a test and return back into the range later on. In trading, we are not predicting, we are just dealing with the odds. Odds can be greater or lower, and all we can do is to stack the odds in our favor. Okay, let's now talk about impulse phase. The impulse phase occurs when market is actively breaking out, so we see a trending day or a day with high volatility. Market is emerging from the previous trading range, and too often beginner traders see the trend just only market is already moving in an impulse phase. In a short-term cycle, it is pretty fast action. Impulse phase can last no more than 2 days, and within this phase volatility increases, so overall volatility of a trending day can exceed volatility of the previous day 3 times or more. Something like this. You have preparation or paradigm shift, and here is a day with a break. Market is always paying too much attention to increased volatility. It is considered as a confirmation of a trend. But think of the market as an auction. It advertises higher and higher until it attracts many buyers who are in the game, and finally price action starts to accelerate. We see culminational movement or excessive movement. Considering that many weaker-handed traders are in the game, big market participants are closing their positions. They have enough volume to do that, and prices are attractive. They are closing their positions with sell limit orders. Once they accumulate their positions within area of accumulation, they can close their position in a distribution area that is often building right after the impulse phase. Example of the impulse phase is shown on the chart on this slide. You see that price action is accelerating, with 2 days of market going down with extremely fast momentum. And as you see, this phase is followed by a pretty elongated sideways action. What can we learn from this slide? It is a bad trading habit in most cases to jump in the market when the movement is underway or when it is completed. I don't say that it is impossible to find a good trade after the impulse phase is over. You also can successfully trade within a distribution area, but principles of trading in the distribution area will substantially differ from those that can be applied for paradigm shift phase or impulse phase. So it is a bad idea to jump in the market right after the impulse phase is completed. You get to the whipsaw. Of course, when you have recognized pretty early that market is entering the impulse phase, for example, somewhere in the 1/3 part of this movement, you can trade within this phase successfully, going against the pullbacks to the short side, particularly in this example, or playing breakout momentum trades with pretty small targets. As market is accelerating, you will see smaller pullbacks, so it is relatively easy to make a trade within an impulse phase. But psychologically, such trades are not easy to take, because you must buy on the top and sell on the bottom. You have to sell on the bottom. It's not psychologically easy. Another example of market accelerating and entering an impulse phase is shown on this slide. Yet there is no distribution area here after impulse phase, and possibly the reason beyond this movement was just shakeout. Market could have become too short, and short coverage rally could have become possible here. This example is from Euro versus American dollar that was moving in a strong descending trend before, and such trends are creating gravitation for the market around recent extremes. So this area is an area of gravitation. Most correctional movements tend to finish quickly and have limited duration. So if you are going with a breakout in a counter trend direction, think about the fact that it is going to reverse soon and set your targets accordingly. On this slide you see a short-term cycle of typical correctional movement in the context of a strong descending trend. It has all features of typical uptrend. Large trading range, or possibly the accumulation area firstly, paradigm shift secondly, and an impulse phase, or the day with high volatility. But what we don't have here is a distribution area. Well, there is some sort of a trading range here, but it's really not the distribution area. Now let's talk about distribution area. What does it look like and how to use it for trading, and why in some cases there is no distribution area. The distribution area, or a distribution phase, is often represented in the form of a trading range with increased volatility in comparison to previous volatility. As I have said previously, distribution area must not always be in place for short-term cycles or for correctional movements in the context of a strong trend. But if the main trend was bullish, for example, and your impulse phase also was bullish, we can often see the distribution area. As you might remember, the impulse phase is a phase of public participation. When public participation is very strong, we observe excessive movements represented in the form of a large culminational swings in the direction of the trend. Imagine what happens after such a culmination. Market is becoming dominated by short-term traders or day traders or swing traders. All those traders are not going to hold position for too long. They try to capture small profits and try to get out pretty quickly. That's why in a distribution phase market tends to generate many false breakouts. It is very hard for the market to sustain a pressure near recent extremes. Price is about to get back in a range in most cases, because too many traders try to quickly take their profits. They are not going to hold their positions. Weaker-handed traders prevent this trend from continuation. It doesn't necessarily mean that all positions of large traders will be closed within this phase. Trend can resume after distribution area completes, but at least for some period of time, something between 2 weeks and 1 month, price will likely to rotate back and forth within this area until new information will come to the market, or new supply and demand will change the landscape. Guess what is the most frequent mistake traders tend to make while trading within the distribution area? The number one in my top list is shown here. Trader waits for the breakout that must confirm a trend or sort of confirm a trend. Then trader draws a trend line and set a limit order on this line. Maybe it can work for some kind of exchange traded products like stocks or some kind of situations, some limited situations, but for the currency market and any other market traded with high leverage, it is not going to work that way. I assume here that trader enters a position with a tight stop. Of course, it is considered that your stop here is tight, because if you place large stop, it can work. But if you have a tight stop, you are going to be stopped in this case, possibly. Remember that here we have two reasons against such kind of behavior. First of all, as you remember, before the market turns to bullish, it tends to be in a sideways action. Secondly, volatility of distribution area is significantly higher than the same volatility for the paradigm shift phase, or even sometimes the accumulation phase. And that's why it is very hard to pick pullback trade here. Even if you buy pretty low price, it will be very hard to pick a good pullback trade. You never know how deep the correctional move is going to be, and it will be very difficult to calculate stop for such kind of position, unlike for a position in a paradigm shift phase. If you see this phase, you see that we have very reduced volatility and you can easily calculate a stop here. But as for this area, it is much more difficult. Your trade location within this phase can be either center of the trading range, like here, or a recent extreme. For example, it can be local high for ascending movement or local low for the descending movement. The first type of trade has to be a breakout momentum trade. For example, when you go, you see the high, you see the pullback, and you can execute a momentum trade in the direction of the break, in the direction of the trend. And the second one is a counter trend trade in any variation. It can be a mean reversion trade, or it can be the destination trade when you are trying to capture liquidation break. And if you trade from inside of the range, it can be done to whatever direction. But if the price hadn't tested recent extreme yet, it is better to go with the trend. Trend remains active and you will have an edge going with this trend rather than going against this trend. When the first test is done, like here, when the first test is done, market becomes weaker and probability of the test decreases. So it may even be better to trade in opposite direction. In the next webinar, we will talk about specific price action patterns that can help you plan your entry and place an initial stop. We have been touching this point in previous webinar, but as this is a very wide topic, there is much to talk about here. If you have any questions or comments to this video, feel free to leave it below and I will do my best to answer all of your questions. Please be specific to receive a good answer. Good luck and see you in the next video.